In this presentation, we will take a look at different terms that will be used when applying present value type calculations to capital projects, mainly having to do with the rate that we're going to be applying to those capital projects. So we've taken a look at different types of cash flows that we can have, how we can present value those cash flows. This is a useful tool for capital budgeting. When we consider capital budgeting, in other words, oftentimes what type of projects should we have, or which projects should we accept, which projects should we invest in order to get a return on those investments, typically resulting in a cash flow that looks like our data set here, where we have initial investment. Then we're going to have some cash flow as a result of that initial investment. The question being, should we invest initially in order to achieve those future cash flows? That's the type of question we typically have with present value with regard to capital budgeting. We often use different types of terms with regards to the rate that we'll be using with a present value function. So when you see a set of data such as this, you can see here that we don't have an even set of cash flows each time. We do have an annuity in here. We could break this out into an annuity and then the components that are not an annuity. But here what we're going to do is we're going to take a look at these each year, look at the cash flow each year, and then we'll present value that information just as we've seen in prior presentations. Our emphasis here is on the interest rate and the different terms that might be used with present value with regards to the interest rate. In other words, once we have this cash flow, what interest rate should we be using in order to present value this information? One rate we may use is going to be the inflation rate. We might say, hey, we're trying to present value this in terms of present value dollars and taking and removing the time value of money or the inflation of the money or the declining in the value of the dollar. So we might say in typical times, the inflation rate would be somewhere between 1 and 5%, let's say. We might say, well, we're going to account for inflation for the time value of money, and then we're going to be comparing projects in today's terms in terms of purchasing power dollars. That's one way we can think about it, and one way we can think about this rate. Another way we might think about the rate is we might base it on the opportunity cost. And when we base it on the opportunity cost, if we're going to present value a cash flow and we base it on the opportunity cost, what we're doing is thinking about the second best option we might have. So we're going to think about the second best option we're going to have. We're going to say, hey, we could get maybe 8% at the bank. So we only want to invest in capital projects that's going to give us some value over that, let's say 10%. In other words, we're requiring that we have a 10% return in order to accept a project. If we run a present value calculation using 10% and thinking that we're going to accept the project if it's above that, anything that has a positive present value, anything that comes up with a positive number, then would be something that we would accept or something that is going to have above the value of the 10% rate of return. That's another way that we might see that. We might have a required rate of return, calculate the present value, and then if we have a positive number, we have cleared that hurdle rate, that rate of return, that bar, and therefore it would meet that requirement for the acceptance. The other thing we might look at in terms of the interest rate is an internal rate of return. So the internal rate of return is the same kind of thing we're thinking about, except we do the process kind of backwards. We're looking for the interest rate, which will set the cash flow, the present value of the cash flow, to 0. So we're trying to say, well, what is this rate at which the cash flows will be 0? That's a little bit more difficult to do mathematically, but easy to do with Excel. So we'll use Excel to do this. In practice, in a test, you would obviously need to know the theory behind it. It would be kind of cruel to make you do the math manually, but it's possible. But normally, you would need to know the theory in a test. In practice, it's a useful calculation. Excel can easily help approximate that calculation with the use of the functions. So let's just enter this data again. I'm going to enter it in with a lot of detail in the data just so we can get an idea of the format that I would prefer typically to enter some type of capital project. We'd have the years. I'm going to say 0, 1, 2, 3, 4, and 5, and then the total. And then the investments, I'm going to break out in each section. So the investments is going to be the $80,000 that we're putting down. In order to receive income annually, we're going to get cash inflows equal to $60,000. And then I'm just going to equal that and copy it down to year 5. The salvage value happens in year 5. So in year 5, we're going to say this equals to the $90,000 minus the 60. That gives us the 30,000 salvage. Then I'm just going to total these across, and this will give us our cash flows. So equals the sum of these, and that gives us our cash flow per year. And obviously the cash flow per year is all we really need. That's going to be this same cash flows. Oftentimes it's nice to break them out in some format by the category so that we can see the totals by category as well. So then we would present value this information. This time we're going to present value at 5%. Now 5%, we're going to say, I think that 5% is going to be basically just the inflation rate. It's going to be the decrease in the value of the dollar, and that's why the 5% has been chosen. It's not taking into account, in other words, opportunity costs, and it's not setting a hurdle rate. It's basically just present valuing the cash flows to today's dollars given purchasing power. So we're going to say, all right, present value using 5%. The first one, nothing, we're just going to take the same number. The second one is going to be negative present value, double click the present value. The rate is 5%, comma, number of periods 1, comma, the payment is 0, comma, and the future value is 60. We'll do this again, negative present value, double click the present value, and present value, double click the present value. The rate is going to be the 5%, comma, the number of periods is 2, comma, payment 0, comma, future value 60, enter. Once again, negative present value, double click, rate 5%, comma, number of periods 3, comma, payment 0, comma, future value 60, enter. Then we're going to say negative present value, double click, rate, comma, number of periods 4, comma, payment 0, comma, future value 60. One more time, negative present value, double click, rate, comma, the number of periods 5, comma, payment 0, comma, future value 90, and enter. So then we could sum those up, and that would give us our 103. Now we could do that a little bit faster by auto-filling. If I delete these, we could auto-fill this across. If we were to do so, if I just copy this down, it's going to be wrong because it's pulling down the 5%. And we need to their absolute value, the 5%. So I'm going to delete that, double click. And this D10, we're going to say F4, put in a $ before the D and the 10, enter. Now we can autofill that down, and it'll pick up the relative cell references as it should. So there we have the 103, 274. Then this being what we think in today's dollars is, given the purchasing power, what this should be as opposed to the actual cash flows, which would be the 150,000. So 150,000 actual cash flows. We're going to say that present value, the purchasing power, given a 5% rate, is 103, 274. And then again, we could copy this all the way across so that we have the cash flows by investment, cash received, and the salvage. Now, the next thing we might do is we might use, instead of 5%, let's say 10%. And in this case, we might call it like a hurdle rate, or we might call it a rate, a required rate of return. We're not just talking here about time value of money in terms of the value of the dollar changing, but this time taking into consideration opportunity costs, where we could put our money. And if we're talking about a capital investment, we could say, hey, I could put my money in the bank. I think I could get 8%. I'm not going to invest in a capital project that has equal risk or more risk unless it's going to be better than a return of 8%, let's say 10%. Let's say we don't accept any project unless it's 10%. I'll just keep it in the bank otherwise. So in that case, we're going to use the same calculation with a different rate, but we might call that rate something different. Now we're going to say this is basically our minimum rate for acceptance, or this is our hurdle rate. And this means that anytime this present value is above 0, then it's a project that has cleared that test. It's a project that's higher than the 10%, and therefore we may accept it under those conditions. So we're not just looking for present value dollars in terms of purchasing power. We're looking for, is it clearing that hurdle rate that we want, the required weight for us to accept the job. So to do this, we're just going to copy the same data down. So I'm going to say, all right, years, I'm going to do this pretty quickly. This is 0, 1, 2, 3, 4, 5. And then we have the total. And then I'm just going to copy this same data. I'm going to copy it from here. So here's the 180. This is going to be the 60, same cash flows. I'm going to copy that down. We're going to autofill that down. It pulls it down. The salvage is going to be equal to the 30. And then we'll total this across, equals the sum. And this is really what we're looking for, this total data, our total cash flows. So here are our total cash flows. Now we'll do the same present value calculation, but with the 10%, more of our hurdle rate, as opposed to the 5%. So I'm going to say this one's the same, because it's year 0, negative present value, double click, the rate, comma, the number of periods, 1, comma, payment, 0, comma, future value, 60, negative present value, double click, the rate, comma, number of periods, 2, comma, the payment, 0, future value, 60, negative present value, double click, rate, comma, number of periods, 3, comma, payment, 0, comma, and future value, 60, negative present value, double click, rate, comma, number of periods, 4, comma, payment, 0, comma, future value, 60, and one more time, present value, double click, rate, comma, number of periods, 5, comma, payment, 0, comma, future value, 90. Now if we sum these up, we're going to get to our 66.75. Now obviously it's lower because we used a higher discount rate. We used a higher percentage. So, and that means that anything that would be positive down here would clear basically the hurdle rate. If this became negative, then it would be something that would be lower than the 10% in terms of cash flow values, and therefore not acceptable if we were using that 10% as a hurdle rate, as a rate to decide whether or not to accept a project or not. So we could sum these across again, equals the sum. And there we have that. Now the other term we're going to have that's related, that could be confusing, it could be kind of scary when we first kind of see it, is this internal rate of return. And that all that means is that we're looking for the rate at which these cash flows will be 0. So what if I was to change this rate, like if I made this some other rate, if I made it, I want to make this go down to 0. What if I said 12? What if I said 13? What if I said 14? And I try to find the rate till it goes down to 0, right? We could do that. A couple ways we could do that. We can use a function in Excel to do that called the internal rate of return. We could use goal seek to kind of figure that if we wanted. Let's take a look at some examples of that. Same data. We're going to enter the data down below, 1, 2, 3, 4, 5, or 0. Sorry, 0, 1, 2, 3, 4, 5, and total. And then the investment, I'm just going to pull the same data down. It's going to be equal to that. The cash flows will be equal to the 60. And then I'm going to autofill this down to year 5. Salvage will be equal to the salvage up above. And the total then, if we sum this across, equals the sum of these items. And then we'll pull that down. Now, we don't know what this rate should be. We could present value and look at that rate, and we can also use a formula to figure this out. So let's just kind of guess a rate right now, and then I'll make an adjustment to it. So let's just say it was 1%. We can then present value this. We can say this equals that number. Let's make it a little bit more dramatic, then let's make it 3%. And then we'll do the same negative present value, and we'll say this equals the rate. I'm going to absolute reference this time by saying F4, $sign before the D, $sign before the number, and that'll make it so when we copy it down, it doesn't move that cell, comma, the number of periods, comma, the payment is 0, comma, the future value 60, and enter. Now we can copy this down. So if we copy this down, there we have it, and we can sum this And we could sum these across this way. Let's do that one more time. There we go. And so now what we're looking for then is the point at which this will be 0. We want to make this what we can make it to make that number 0. Now, one way we could do that is that you could use the goal seek number to do that. You could go to the data up top. We could say forecasting tools, what if analysis, goal seek. And we could say, hey, Excel, we want to set this cell to be 0 by changing this cell. And it's very complex. It's a lot more complex than we've seen goal seek used in the past, but they're all related. So this cell is related to that cell in some complex way. Excel will just keep on picking numbers until it finds the one that it should be to make that 0. So once again, we're saying, hey, Excel, set this cell down here to make it 0 by changing this cell up here. Change the percent to whatever you can. Just keep testing things until that turns out to be 0. Okay. So if we do that, we're at 23. Oh, if we do that, we're at 23%. Let me demonstrate that one more time because I deleted it. We'll say goal seek. We're going to say set this cell to be 0 by changing this cell. Okay. And then you have to hit OK. So there's the 23%. The other way we can do it is by setting a formula up top. So I can say, what if I didn't know this cell at all? It's 0 right now. I can say this equals the internal rate of return. Internal rate of return, double click that. And then we just want to, all we have to do is pick the series of numbers. So it's years 1 through 5. I just pick the series 1 through 5 and say enter. And then it'll use that formula to take that series and basically do what we did in this table with the goal seek and figure out what rate this should be to make this 0. So whenever you hear these different terms, it can kind of confuse people at first. We hear present value of money, and when we first hear present value of money, we think, oh, you mean purchasing power, because I know $1 is going to be worth less than it is today because it declines in value. That's purchasing power. And then you hear something like a hurdle rate or required rate of return, and you're like, oh, that's kind of purchasing power, but it also takes into account opportunity costs typically. What could we do in our second to best option? And so we're going to use the same kind of formula, the same thing, but the term in terms of how they got this interest rate could differ. And then we'll come down to the internal rate of return, which again sounds completely different in some ways, but it's really not. All we're talking about is the interest rate at which this becomes 0, which would be complex and mind-boggling mathematically if you had to do it by hand, but conceptually it makes perfect sense. And if you do it by a goal seek analysis or just using the IRR, internal rate of return formula, then you can basically intuitively understand it fairly well and be okay with that as well and see how it fits in and use it properly.